What's up, everybody? This is Will from Market Rush Trading. Right now, I'm drinking Coco Rico, whatever that is. Doing this for you guys. Um, let's get into intro to dividends. As you guys may know, some investors they like this dividend game because it offers consistent returns on relatively low risk investments. Right? That's why we love it. Now, at the same time, there are ways in which you can receive dividends on a monthly basis. As we all know, dividends are paid out quarterly or annually, right? But there are different tactics, the dividend game that we can play where we can receive it on a month to month basis. So let's get right into it. Now, what are dividends? Dividends are a part of regularly paying business profits to their shareholders on a pro rata basis, charged as a fixed amount per share, right? That's what pro rata means, proportion. Periodically. That periodically basically means every quarter. There are full quarters in the year or annually. Now, let's play the dividend game. Basically, an investor or trader purchases shares of stock before the ex dividend date and sell the shares on the ex dividend date or any time thereafter. If the share price does fall after the dividend announcement, the investor may wait until the price bounces back to its original value and move on into the next. So this is a picture depicting what this is saying. So receive a dividend every month. January we have Cisco. February we have Apple. March we have Microsoft, and respectively the next 3 months it goes the same way, right? Just for the same as for Chevron, JPM, and AT&T, you could do the same for them as well, right? But this is how the dividend game is playing. You put in a lump sum of money into the stock, receive the dividend, and then move forward into the next one. Now, there are three ways that dividends are paid out, right? Now, again, they may be allocated in different forms of payment. So the first one being that it may be paid out in cash. Second one being that it may be paid out in additional stock reinvestment or property. Now, cash dividends are the most common because it's being paid out as currency via electronic funds transferred to your brokerage account from the company that you invested in. So let's say, for instance, you have 2,000 shares of company XYZ and they pay a cash dividend of 90 cents a share, right? The holder of the stock will be paid about 1,800, which would be the 2,000 multiplied by the amount of cash dividend paid out per share, right? That'll be 2,000 times 0.90 and you get 1,800. So additional stock, this is a stock dividends reinvestment, also known as scripts, right? They are payments in the form of additional stock shares of the company itself or one of its subsidiaries, right? Now, a lot of companies may want to do that because they prefer to use it towards their earnings, right, in terms of growth, rather than diverting that into cash dividends for shareholders. Now, property, we don't hear about it much, but those are paid out in the form of assets from the issuing corporation or another corporation such as subsidiary. Now, we don't actually use that, so I won't get into it. So now let's move forward. Now, this is the process of paying out dividend for companies. So let's say companies XYZ made a profit of 3 million for the year, right? Shares outstanding is about 2 million shares outstanding. EPS, earnings per share, is $2. Now, companies doing well and wants to share the profit with the shareholders because they gave money to the company, right? Now, companies will decide that they will pay out a 500K of their profits this year to their shareholders. Now, every shareholder will receive the amount of profit to them, which is 500K, divided by the shares outstanding, which is 2 million. Then you left with 0.25 cents a share. Now, investors can choose to, as we explained before, cash dividend or choose to reinvest by buying additional shares. Now, the profits that is left is invested in the company for future growth in terms of increased profits or even dividend the next year. Now, categorizations of dividends. Now, there are two forms of dividend. We have what we call common stock and we have what we call preferred dividends. Now, before any common stock dividends are distributed, preferred stock owners get their dividends paid out in full first. The reason why is because preferred stock gives no voting rights to shareholders while common stock does, right? So because preferred shareholders have priority over a company's income, they get theirs first. It's only right that they get theirs first. Now, these are terms to review for you guys to know. Dividend, it is a prorated payout by a corporation to its shareholders, generally paid on a regular basis, which we've gone over that in the beginning in terms of quarterly or annually. Dividend yield. Dividend yield refers to the ratio between dividends per share and the market share. It is calculated as this: the total annual dividend payment per share of a stock divided by its price per share. Then we have dividends per share. Literally, the owners receive the sum per share. Now, what pro rata means is proportional. So every shareholder gets an equal proportion for each share he or she owns. Now, these are the ratios that we need to really understand and pay attention to because they really matter. So the formula for dividends per share would be what we just did: annual dividends divided by the purchase price. Dividend yield, which refers to, again, the ratio between dividends per share and the market price of its shares, and it is expressed in terms of percentage. That is annual dividends per share divided by the price per share. Now, the payout ratio is calculated by dividing the company's dividend by the earnings per share. So as you guys can see here, we have two form of calculation. Number one being total dividends divided by net income. Another way you can find this is dividends per share divided by EPS. And the reason why is because if you look at the EPS formula, you have net income minus preferred dividends divided by weighted average shares outstanding, and from that you could derive the dividends per share divided by earnings per share, and you get your payout ratio. Now, a payout ratio greater than 1 means the company is paying out more in dividends for the year than it earned, while a low payout ratio indicates that the company is retaining a greater proportion of their earnings instead of paying out dividends. So always keep that in mind based on certain decision a firm makes, right? It serves as a signal device about a firm's future's prospect for the investor, right? So we make our investment based on those decisions. So always keep that in mind. Now, these are the 6 important dates to know for publicly traded company, especially if you want to get into this dividend game I'm talking about. You need to know what these means. You need to get with the game. Stop playing around. Do your homework. So the first one is declaration dates. That is the day the board of directors announces intention to pay a dividend, right? Now, on this day, a liability is created and the company records that liability on its book. It now owes to the stockholders. On that day also, they will announce a date of record and a payment date. Now, the second one you guys need to be aware of is in dividend day, which is the last day, one trading day before the ex-dividend date where the stock is said to become dividend, right? In other words, this is what it means, guys. Existing holders of the stock and anyone who buys it on this day will receive the dividend, whereas any holders selling the stock lose their right to the dividend. After this date, we get what we're getting into, the ex-dividend date. Now, the ex-dividend date, typically 2 trading days before the record date for U.S. securities, for U.S. securities. Now, this is the day on which all shares bought and sold no longer come attached with the right to be paid the most recent declared dividend. This is an important day for any company that has a lot of stockholders or a lot of people investing in them, right? Because existing holders of the stock will receive the dividend even if they now sell the stock, whereas anyone who now buys the stock will not receive the dividend. And this is critical information because remember, with the dividend game, we're not holding these companies for years out. We just want in and out, in and out. So we want to know when exactly to get in, right? Now, we have a book closure date. You guys really need to keep track of that as well. Book closure date is when company will ideally temporarily close its books for fresh transfers of stock. Record date refers to the date that shareholders must be registered on record in order to receive the dividend. Shareholders who are not registered as of this date will not receive dividend, guys. And Last but not least, we have payment date, which is the date when the dividend will actually be distributed to the shareholders of a company or credited to a brokerage account. That will be that cash dividend I'll tell you guys about. So this is basically it, guys. Why do a lot of investors get into dividend? As I've said before, dividends on fairly low risk assets deliver stable returns. Although fast growing companies are unlikely to give dividends, but mature companies, businesses like Coca-Cola, Johnson and Johnson, AT&T, what else? There's a couple companies, man. There's a couple companies that are able to give you that dividend because, right, they have less space for growth and they're pretty stable. They have that foundation. They can take a hit because they have a lot of cash, right? But those are the things that you guys might want to focus on because let's say certain dividend decision, right? Like I said before, that may serve as a signal device for future prospect. So you as an investor, when you look at certain decision made, you could actually choose to invest or not, especially for those who wants to invest for the long run, right? So again, this is basically it. I hope you guys understood this, and I hope you guys dive into more research on how can you take advantage of receiving this passive income on a month to month basis or even on a quarterly basis based on the funds available. But to start with, start pretty small, manage your risk properly, manage your emotion, don't trade on emotion, do your research, do your due diligence, and just never forget, be lavish.
Thank you for watching. I hope you enjoyed and learned a lot from the video. Go ahead and smash that like and subscription button and follow us on social media for more content. And stay tuned for the next video.